All right, thank you for joining us today. We're doing things a little bit differently. So we're going to do a webinar today talking about value investing, which I think is a pretty pertinent topic given what's going on in the market. But we are actually pre-recording this because I am going on vacation. Can't ask any questions, but you can, of course, contact me at mark.lamonica1@morningstar.com if you do have any questions. All right, so as I said, value investing. We're going to explore what it is, what has been happening in the market right now, and sort of how you should think about it and some of the ramifications that you should think about as an investor. But first, still have a couple housekeeping items. So number one, anything you hear today is general advice. I don't know anything about you, so of course I'm not offering any personal advice. If you're over in New Zealand, you can go to our website, morningstar.com.au, to find our FAP. And also the New Zealand regulatory authorities would encourage you to speak to a financial advisor if you are seeking personal advice. All right, so let's do this. Value investing. Let's talk a little bit first about what is value investing. So very simply, we divide the market up into two different styles, sometimes three if we include sort of the middle of the market, a core portion, but we divide shares up between value shares and growth shares. Now, a couple things to note. When we are making this division between these two different categories, we are looking at relative valuation measures like the price to earnings ratio, the price to book value ratio, and the price to cash flow ratio. And we're simply saying that the less expensive shares that are trading for a cheaper valuation level go in this value category, and the more expensive shares go into a growth category. Now, one thing that's very important to note is that there is no reason why a share cannot be a value share at one point in time and then be a growth share at another point in time. There's nothing intrinsic about those individual companies that put them in one of those categories. It simply reflects the valuation level that they're trading at. So for instance, if a share that used to be really cheap, all of a sudden the market started liking a lot and became very expensive using those relative valuation measures, it could go from value to growth. So there's nothing to say that a share is in one category, but there are some generalizations, which we'll talk about in a little bit. And the concept, the theory behind value investing is that as any investors, we are paying for future cash flows that come from shares. And the premise around value investing is that it is a good thing to pay less for those future cash flows. And those are, of course, reflected in those multiples. So we've got a couple of definitions on the slide that I'm not going to go through, but really looked at some of these different factors that we're using to divide shares up. So one thing that we do need to look at is sector. So as I said, any share, and of course any sector in the market, of course, can be value at some point and then growth at another. And we're making broad generalizations here, but in general, there are certain sectors that fall within the value side of things and certain sectors that fall within the growth side of things. So if we look at the financial, the industrial, utilities, energy, materials, consumer staples, and real estate, they are generally overweight value. And what that means is that most of the shares within those sectors would fall into the value category most of the time. Then when we start looking on the growth side of things, we've got information technology, consumer discretionary, healthcare, and communication services that in general are overweight growth shares, meaning, once again, that most of the shares in there would be categorized as growth shares most of the time. And so what we've seen in the market, and we'll get into some more specifics about what's happened, what we've seen sort of since the beginning of the fourth quarter in 2021 is that we have seen what is called a rotation to value. So for a very long time, we have had outperformance by growth shares, really since the GFC. And this outperformance by growth shares, of course, you've probably seen a lot in market news. We've seen how well technology shares have been doing, and other shares that fall into some of these other categories like financials, like energy, have not done well. Well, we've seen that starting to change. And we've seen this rotation back into value. So value, after underperforming growth for a very long period of time, has started to outperform, particularly that fourth quarter of last year, and then what we've seen in the first, 4.5, 5 months of this year. We've seen that rotation to value. And what you can see on this chart is what we've done is we've looked at the US market. We've looked at all the different sectors, the ones that we just named, and put into different categories. And what we're looking at now is the price to fair value. So price to fair value represents what our analysts believe those shares are worth. In this case, we are taking all those shares in the US and putting them within sectors. And price to fair value, anything over 1, we believe is overvalued, right? The price would be more than what we think it's worth. Anything exactly at 1, we would consider to be fair valued. And anything below 1, any sort of fraction we have below 1, would represent something undervalued. For instance, if we look right here at basic materials, 0.94, that would mean it's 6% undervalued, right? Because it is 6% below 1. So what we can see is if we look at the current price to fair value, then we go back a year ago, we can start to see the impact of what's happened. If we look at the overall market, we see in the US, we thought it was 8% overvalued a year ago. Now we think it's 9% undervalued. That reflects the market going down. But if we look at a couple different categories here, so let's look at energy. So energy is generally a value sector, as we talked about before. We see a year ago, it was 14% undervalued. Now we think it's a little bit overvalued. And that reflects that rotation. And conversely, if we go and we look at technology, we thought it was 6% overvalued a year ago. And then we've actually seen that rotation off, now 15% undervalued. So that's the impact of that rotation. What you can see is those valuation levels are actually getting cheaper. All right, the other thing that we should talk about, and we'll get into some more specifics in a second, but the other thing that we should talk about is when have we seen this rotation before? Because of course we're interested in, as investors, in how long this rotation will actually last. And the example that comes up a lot, and I will say that this is an example we talk about a lot during our podcast, talk about a lot on these webinars, is we go back and we look at that .com bubble that burst starting in 2000. And we like to talk about it a lot because I think I personally see a lot of similarities with where the market is and was right now with .com. We had these extreme valuation levels for very risky securities, in many cases securities that weren't making money or were making very little money, that were kind of continually bid up. And there was this giant sort of retail surge in 2000 that went into tech shares. Well, we see sort of similar things now. And that was actually a huge rotation. As that .com bubble burst, a huge rotation back into value from growth. Once again, all those technology shares in 2000 and now were all growth shares. So through April, so talking about the first 4 months of this year, so US growth shares posted their weakest performance since 1932. So what we are seeing is very unusual. But if we go back and we look at 2000, we can look at two different things here. So we're seeing the relative valuation using the price to earnings ratio of US shares. And this is dividing up that bucket of US shares by growth and by values. You can see here, back in 2000, growth shares were trading at 35.6 times earnings, where value was trading at a little over 15. We go back and we look where we are in April, 34 times earnings versus 14.3. So once again, we can see that there are large differences between those two categories of shares. And something important to remember is that this rotation took around 3 years in the year 2000. So obviously we have no idea what's going to happen to the market, but history would suggest that perhaps what we've seen so far could just be the early portion of this. And when we think about growth shares in general, and we'll get into this a little bit more, just remember that obviously those higher valuation levels that you are paying, that is more risk that's in those shares. And I think the market collectively right now, at least so far, has decided that risk is not a great thing right now. And given everything that's going on with inflation, with interest rates going up, with the war in Ukraine, with COVID lockdowns in China, I think the market is obviously taking a step back and reevaluating risk and what the risk reward that ratio that basically people want to take with different investments. All right, let's quickly look at performance, and we'll talk about implications and sort of how you can think about this as investors. So what I've done is I've just taken a snapshot. This is called the Morningstar Market Barometer. So we're looking at shares, and once again, this is the US. We are looking at shares in this box across two different categories. We're looking value to growth, and in this case, we have core, right? Those are those shares right in the middle. And we're looking at market capitalization. So how big are the companies? So small to large. So small companies, large companies. And what we're looking at here is we're taking 4 different snapshots. We're taking a 1-month look, a 3-month look, a 1-year look, and a 3-year look. So what we can see is over time, as represented by the red on here, is we can see that outperformance by value. So for instance, if we look at this 3-month period, large caps, so large companies that fall in the value category, still have a loss. Same thing with the 1-month period, but are significantly outperforming growth. And this is really that rotation that we've seen. So you have not necessarily made money in the short term by investing in value, but you have not lost as much. And then, of course, we can see the different impacts as we go back on different time periods. So this is basically representing what we've seen. We've seen that rotation, really starting at the end of the third quarter of 2021. And we can sort of see that rotation. All right, so what does all this mean? So it's nice to go through stats, obviously, but it's also important to figure out what should we do as investors? What does all of this mean? So the first point I think is very important. There is no reason that you need to be a value or growth investor. You can have both in your portfolio. There may be different times when you would invest in one or the other based on valuation. So when you're going out there and trying to build a diversified portfolio, there may be good times to go invest in growth shares, because even if they're more expensive on a relative basis, we go back to this slide, right? On a relative basis, you could say this is way out of whack. I do not want to pay more than 2 times for growth shares, but there are times where they could come down and you think that they're more appropriate. They're actually cheap. Remember, just by being more expensive does not mean that they are not cheap, because of course there's lots of other factors we need to look at. So you can use both. You do not need to commit to one or the other. Obviously, I think it's important with all this stuff and with all investing is you need to find a strategy. There are lots of strategies that work over the long term, but what's really important in all of those is sticking to them. So it's also about finding what are you most comfortable doing. Are you more comfortable with potentially higher volatility shares on a growth side that potentially have higher possibilities for rosy futures, or they're more interested in value companies, which maybe are plodding along, not growing as fast, not doing the sexiest thing in the world, but you're more comfortable with that and maybe the less volatility to come. So find something that's comfortable, because the most important thing, once again, is to stick with it for the long term. So the second bullet point is really important, right? Is cheaper always better? Well, of course not. Of course not. Buying the cheapest thing, just like buying the cheapest product, is not always the right decision. But it's really important to make sure that you know what you are paying for. You understand what you're paying for, and you understand that differential that you're paying for. And there are a lot of reasons to pay more for a share, right? The reason that a lot of these growth companies are trading at higher multiples is for a reason. And let's take technology as an example. So tech shares have traditionally traded at higher multiples for a lot of these very good reasons. They've typically been growing faster. They typically have higher margins. And we'll talk about why in a second. They get higher returns on capital you're investing, and they're more scalable businesses. And all of these, of course, are related. So if we think about a technology company versus, let's say, an energy company, let's take an oil company. So growing earnings in oil. So how do you grow earnings in oil? Obviously, there's a price side of things, but also you need to continue to produce oil. And producing oil is not easy, right? You need to go find the oil, number one. So there is an exploration side of things. Generally, where you find it is not the easiest place to then drill for oil. So we certainly see this, platforms in the middle of the ocean, up in the Arctic. Generally not the easiest place to operate a business. You need to build a lot of infrastructure, right? You need to build a lot of infrastructure to drill that oil. You need to have transportation infrastructure to take it to wherever you want to sell it. You need to put it through a refinery. You need to deliver it to a petrol station. There's a lot you need to do, and it takes a lot of investment to grow and scale that business. And it even takes a lot of investment in that business just to keep it operating at the same level, just to continue to produce the same amount of oil, because obviously it's a finite resource. So compare that to a technology company, and I'm exaggerating a little bit here, but technology companies are very scalable. So we of course know the classic story of, a couple people sitting in a garage that invent some new website or app or anything else, and all of a sudden they start selling it, right? So to produce an app that is used by one person is pretty much the same as if it's used by 1 million people, especially now that there are all these different ways to scale your business through cloud computing, for example. So technology companies generally scale more. So what that means is that as they get bigger, as they grow revenue, they're keeping more of those earnings. So they have higher margins. That represents higher margins. They're more scalable, as we talked about. It's generally pretty easy to grow them without making all these huge investments. That means the capital you do invest in your company is generally around people. And you can hire some people, obviously, and as you expand, you need to hire more people, but not to the scale that you would need to hire people if you were running a factory or, drilling for oil, for example. So there's all of those reasons why certain companies that have those attributes should be trading for a higher multiple. They should be more expensive. But once again, remember the question is, how much more should you pay for them? The other thing that's important is thinking about what a high multiple represents. So I alluded to this earlier, that it is more risk, but anytime you're investing in shares, you're of course investing on what that company is able to do in the future. We don't really care about the past. The past, of course, can offer us clues into the future, but that's really what we're interested in. So the more that you pay for shares, the rosier that future needs to be, because that, of course, is priced into the share. These high expectations about the future are priced into the share. And when those high expectations don't occur, and it is harder to meet high expectations than low expectations, right? We all know that from life. If those high expectations do not occur, even if overall the company is doing well and doing well compared to other ones, but we're comparing about actual performance with expectations. So it's important to know what future scenarios are priced into shares that you purchase. And I think we're kind of seeing that right now, right? We're seeing the market reevaluate the future, reevaluate these expectations that we heard from central banks saying interest rates weren't going up till 2024. Obviously, that's not true now, right? So the market's reevaluating these scenarios, reevaluating the fact that they thought there was going to be, the market collectively, we all thought that there's going to be low inflation forever, potentially. Reevaluating that, reevaluating geopolitical stability that we thought that stuff like Russia invading the Ukraine would never happen. Well, people are reevaluating security in Europe now. So just remember, those expectations are what matters, not how the company does on an absolute basis. And of course, with growth shares, where you're paying more for those shares, generally those expectations are higher. Finally, another big thing we need to consider when we're looking at value and growth is changes in interest rates. So we'll spend a second, and we do have other webinars where we talk about valuing a share. We'll spend a second talking about how you value a share. So generally what is done is you use a discounted cash flow model to value a share. So what we're doing is once again, we care about the future. We're predicting out cash flows into the future. We are discounting them back. So that discount rate is very important. The higher the discount rate, the less things are worth in the future because we're discounting them by more. The lower the discount rate, the more those cash flows are in the future. So the discount rate is impacted by the level of interest rates. So if we have higher interest rates, we have higher discount rates. Higher discount rates mean that we are discounting future cash flows more and they are worth less. So mathematically, if we think about a company that we expect to grow very fast, earn a lot more money, increase those cash flows, out in the future, those cash flows, the more that we think a company is their earnings and their future is further out, the more we're going to discount them, the less that company's going to be worth. So basically what we are saying here is that growth companies are worth less. Companies that have a ton of growth way out in the future, projected way out in the future, they are worth less in higher interest rate environments. So that is something else that's going on now. We, of course, are all changing our expectation of future interest rates. So that's something to consider as well. And one last really important thing to think about is what happens when the economy is not doing well. So growth shares are generally companies that are in better shape. They have better future prospects. They probably have better financial situations right now. And so when the market or when the economy is not doing great, those companies are more likely to be able to hang on through those economic downturns. Value shares, maybe their finances are a little more precarious. Maybe they're not able to do that. So maybe they're more at risk of going out of business. That's why people aren't willing to pay a lot for them. So think about the economic conditions that are coming up and thinking about what companies will thrive. And remember that, of course, the economy is not the share market. The share market going down does not mean that the economy is going to do poorly. There are times where they are very different. And you're getting different outcomes in the share market versus the economy, right? The economy was not doing very well during COVID lockdowns. Now, we were all anticipating the future when that was over, but the share market was doing well, the economy was not doing well. Just think about those factors and think about how that's played out since 2020 and probably since 2008-9 when we came out of the GFC. So just a couple things to consider. Hopefully this is helpful. That is value investing. Just remember, you don't have to be a value or growth investor. What you do need to be as an investor is you need to understand what you're paying for and make sure what you're paying for, you're paying a reasonable amount. So thank you guys for joining. Once again, if you have any questions, just send them through to my email.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.